Do you know what an economic crash is? Why do countries face an economic collapse? Do these questions trigger your mind to know it? Well, are you interested enough to know the reasons why countries' economies fail? Well, I've got your back. In this video, I'll be breaking down all the things you need to know about economic collapse or crash, including the reasons and some frequently asked questions about it. Let's get started. So what is an economic crash or collapse? A national, regional, or territorial economy that has collapsed usually comes after a period of crisis. Depending on how severe the conditions are, an economic collapse can start at the beginning of a severe economic contraction, depression, or recession and extend for any number of years. An economic collapse may occur suddenly as a result of an unanticipated incident, or it may be preceded by a number of occasions or indicators that the economy is fragile. First, economic collapse is not a normal feature of the expansion and contraction of the economy. Second, the most obvious sign of an economic collapse is a general breakdown in trade and routine market operations. Third, due to its widespread effects, the Great Depression of the 1930s is regarded as one of the worst economic crises in history. However, the impact of the 2020 COVID-19 pandemic is still unknown. An economic collapse is a rare occurrence that's not always associated with the regular economic cycle. It can happen at any time during the cycle, causing stages of contraction and recession. An economy can go through a number of stages according to the economic theory. A complete economic cycle involves movement from a trough to an expansion, a peak, a contraction that moves the economy back toward the trough, and so on. Black swan events or trends in the global economy can override any point in the cycle to trigger an economic collapse, even though they should be more likely in an economy that's already contracting. Contrary to contractions and recessions, no accepted definition of an economic collapse exists. Instead, economists and government officials may use the word economic collapse as a label, and this may happen months or years after the actual event. Governments also frequently use the phrase economic collapse when planning significant stimulus measures amid market panics. In order to support the case for government intervention in the economy, the possibility of economic collapse is brought up. So how do you respond to economic crash? National governments have a significant motive to try to prevent or decrease the severity of an economic collapse through fiscal and monetary policy. Despite the fact that economies can and still do experience it, economic collapse is frequently fought using a series of fiscal and intervention measures. For instance, banks might be compelled to close in order to reduce withdrawals. New capital controls might be implemented. Billions might be injected into the economy through the financial system, and whole currencies might be revalued or even replaced. Despite government attempts, some economic crises lead to the total overthrow of the government, which was both the cause of and the solution to the crisis. There are nearly always a number of legislative reforms made in the wake of an economic collapse with the intention of preventing a situation similar from occurring again. These adjustments are typically motivated by a post-collapse analysis that aims to pinpoint the crucial elements that contributed to the collapse and incorporate restrictions into new legislation to reduce those risks in the future. As the memory of the economic crash recedes, the appetite for these financial controls may wane, which might result in a relaxation of the restrictions on hazardous market conduct. So what are the reasons for an economic crash? Number 1. Loss of consumer confidence. Consumers stop buying when they lose faith in the economy, which can create a vicious cycle. The necessity for or ability to afford to hire new workers will gradually decline if the demand for goods and services is sufficiently low. As a result, the economy will create fewer jobs, sales will continue to decline, and producers will generally reduce output in response to the declining demand. Reducing output also entails reducing employment, which raises the unemployment rate and prompts people to reduce their spending. Number 2. High interest rates. Increased borrowing costs as a result of higher interest rates deter consumers and businesses from taking out loans to finance purchases or investments. The economy's demand for products and services declines as a result of lower spending. Because of the decline in demand and the ensuing production reductions, firms hire some personnel. Inflation declines as economic spending declines. However, a recession may occur if rising interest rates push the economy into an unsustainable state of contraction. So what causes interest rates to fall during a recession? Because central banks utilize monetary policy to promote growth, interest rates may drop occasionally during recessions. This provides an incentive to invest rather than hoard money in a bank account. In other instances, interest rates decrease during a recession as a result of investors' frenzied pursuit of bonds' comparatively high level of safety. This purchasing pressure can keep interest rates low. Number 3. A stock market crash. A recession might result from a stock market meltdown. Investors frequently have less money to invest in enterprises as stock prices fall. Layoffs or hiring freezes may result if businesses are unable to raise the necessary funds for expansion and running expenses. Some of the most significant stock market crashes in American history occurred right before a downturn in the economy. These include the Black Tuesday stock market crash of 1929, the financial crisis of 2008, and the COVID-19 related short-term slump. Number 4. Post-war recessions. In American history, post-war recessions have occurred regularly. After World War II, the Korean War, the Vietnam War, and the Gulf War, there were recessions. Following the Korean, Vietnam, and Gulf Wars, there was a 4.5% decline in annual growth and an increase of 1% in average unemployment. Number 5. Credit crunches. A credit crunch happens when there's an unexpected decrease in the amount of money that may be borrowed, which reduces the number of loans. For instance, during the 2008 financial crisis, banks suffered significant losses as a result of the high number of defaulted mortgages and the faulty mortgage debt they had purchased. They were extremely hesitant to make loans as a result of these losses. Interest rates rise and less money is available for businesses and individuals when lenders are more cautious. That might cause a recession. Number 6. Deregulation. When they eliminate crucial safeguards, legislators run the risk of starting a recession. When the Garn St. Germain scandal broke in 1982, it laid the groundwork for the savings and loan crisis and the ensuing recession. The Depository Institutions Deregulation and Monetary Control Act of 1980 and the Germain Depository Institutions Act, both of which were passed, eliminated the limitations on loan-to-value ratios and interest rate caps for savings and loan associations, respectively. The savings and loans crisis was the primary factor in the 1990 recession, which resulted in the failure of more than 1,000 banks with a combined asset value of $500 billion. Number 7. When asset bubbles burst. Asset bubbles develop when the costs of investments such as gold, equities, or real estate go beyond what's reasonable. When a bubble pops, it already creates the conditions for a recession to take place. The housing bubble and the dot-com stock bubble occurred just before the recessions of 2001 and 2008 respectively. Number 8. Deflation. Deflation lowers the market value of the goods and services being offered, which motivates consumers to hold off on purchases until costs are lower. Since they cannot afford to take on debt at such high interest rates, it's frequently linked to high interest rates, which may also make consumers wait to make purchases. Because businesses need to reduce expenses, deflation can also result in a rise in unemployment. Due to the fact that unemployed people often are unable to spend money to stimulate the economy, this could result in a deflationary spiral. Number 9. Hyperinflation. When the government prints an excessive amount of currency and permits inflationary pressure to build up in the economy, prices for goods and services gradually increase. This is known as hyperinflation. In an effort to control a downturn in the economy, governments turn to create an excess of money and credit. When the government's unable to manage price increases and must raise interest rates to slow the rate of inflation, hyperinflation results. Number 10. Stagflation. Stagflation is a term used to describe a situation in which inflation is rising and the economy is growing slowly. Policymakers face a problem because of this economic predicament, because the actions are taken to combat the inflationary surge risk pushing unemployment rates to uncharacteristically high levels. The impacts of stagflation on the economy could extend for years or even decades. For instance, from the 1960s to the 1970s, the United States had stagflation. Economic growth remained flat during that time, while inflation peaked at 13% annually, compared to 20% annually in the UK. Stagflation is typically hard to control once it starts, and governments often have to spend a lot of money to restore economic balance. Number 11. Stock market crash. A stock market crash happens when investors lose faith in the market and there's a sharp decrease in the values of all the equities that are traded on the stock market. A stock market crash results in a bear market, when prices drop 20% or more from highs to new lows and depletes enterprises of money. When stock prices are growing over an extended period of time, price-earning ratios are higher than typical over the long term, and market players are using margin debt excessively, crashes happen. Number 12. The 2008 Recession. Early in the 2000s, there was a housing bubble and insufficient regulation. Banks and lenders permitted customers to obtain mortgages they couldn't afford to repay. Consequently, a lot of consumers purchased properties they couldn't afford. Predatory lending practices affected many of these borrowers. These debtors ultimately had to stop making loan payments. Housing prices fell as a result of the foreclosures, and millions of Americans lost their homes. Mortgage-backed securities, a class of bond or investment that's secured by the value of the mortgage, were also produced by financial institutions using these mortgages. These mortgage securities were also used to generate derivatives, which followed the performance of the underlying mortgage securities. Financial institutions also sold credit default swaps to protect investors from MBS losses. Over time, the entire financial market became exposed to these instruments in some capacity, which meant that hazardous mortgages were eventually exposed to the entire financial market. In the end, a large number of the largest financial institutions suffered significant losses on their mortgage-related assets. Number 13. The 2020 Recession. Due to the COVID-19 shutdown in March 2020, the US economy shrank. The global COVID-19 pandemic, which forced the majority of businesses to close their doors in order to prevent the coronavirus from spreading, was the black swan event that caused the 2020 recession. Real GDP fell by 5.1% in the first quarter of 2020. The COVID-19 effects on the US labor market fully recovered in 29 months, which was quicker than any other recession in the previous 40 years. So, what are the scenarios that imply economic collapse? Number 1. Rising interest rates. Interest rates peak at exceptionally high levels during times of economic collapse, which reduces the amount of money available for investors to invest. High interest rates impede economic growth because it's expensive for investors, businesses, and the government to service their existing debt obligations and obtain new loans as a result of the high cost of capital. Investors lose faith in a large firm and will be reluctant to trade their money during times of financial difficulty if it proclaims its inability to finance its debt obligations and resorts to selling off its assets to pay creditors. Number 2. Sovereign debt crisis. A government may incur sovereign debt to pay for capital-intensive infrastructure projects. The risk of the government defaulting on its existing debt obligations and going bankrupt rises, though, if it takes on too many loans and is unable to make principal and interest payments when they're due. Wars, political unrest, droughts, weak economic growth, and investor mistrust of the government are all risk factors for sovereign debt crises. A government default is likely to have an impact of the global economy and have repercussions in other countries due to the number of sovereign obligations. Number 3. Local currency crisis. When a local currency loses value as a result of a decline in investor confidence, a crisis has occurred. This happens when foreign investors who've made investments in a nation and given the government credit start to lose faith in its capacity to pay its debts or create the promised profits. In such circumstances, foreign investors stop making investments in the nation. The action boosts the selling of the borrowing nation's currency on the world market, which devalues the currency. The country's overseas debts rise because of this, decreasing its purchasing power. Number 4. Global currency crisis. A major currency utilized in cross-border trade transactions between people, businesses, and governments lose value, resulting in a worldwide currency crisis. For instance, the US dollar is used as the reserve currency for the world in the Bretton Woods institutions, which means that a decline in the value of the US dollar might result in an international economic crisis. At the end of the day, a period of national or regional economic disintegration is referred to as an economic collapse, and it can last anywhere from a few years to several decades. A nation is defined by social unrest, bankruptcies, decreased trade, currency instability, and a breakdown of law and order during times of economic distress. Government interventions for economic recovery can be delayed to get the economy back on track due to the severity of the financial crisis, and the weight worsens the economy's disarray. So did this video help you to further understand the economic crash? Why not share your thoughts in the comment section below? We love to hear from you. Also, check out more of our videos about your financial journey in this channel. Don't forget to click that subscribe button, ring the notification bell, hit the like, and share this video with your money and business-minded friends. Till next time.